Hello friends, welcome to Business Charts. This analysis is about L&T Technology Services, a technology company working on electric vehicle, advanced driver assistance system, autonomous drive, 5G, IoT, AI, data analytics, digital twin, voice as a service, and so on. So let's find out good and bad in this company. This fundamental analysis covers last 8 years financials, ratios, valuation, investors, and forecast. Sharia compliant statement of the company is passed in all applicable sections. If you are planning for US stock market investing, IND Money is the best application which simplifies so many processes and time. It offers US stock investments with zero fund transfer fee, zero account opening fee, and best forex rates. Sign up with our link below and fund your US stock account with 10,000 rupees. You will get 1000 rupees worth of Tesla stock as a welcome gift. Starting from financials, sales were increased 2.5 times in the last 8 years and CAGR is 14%, and only one time year-on-year growth is negative. So good sales CAGR and consistent sales growth except 1 year. The net profit increased 3 times in the last 8 years and CAGR is 17.4%, and only one time year-on-year growth number is negative. So good net profit CAGR and consistent profit growth except in 1 year, and no loss-making history in this period. The company don't have any raw material for their business. Major expenses is employee cost, which is around 55 to 65% of the sales. Comparing to operating profit, the other income is contributing quite a high amount. 5-year average other income is around 20% of the operating profit. For me it is high. If it is less than 10% means then okay. Always core operations should generate more money because consistent higher other income is not good for any business. They can use the other income to manipulate the net profit growth. From the balance sheet we can understand it is a debt-free company and good equity portion, so healthy balance sheet. And asset side, cash and short-term investment which is around 34%. So they have enough liquid assets. The operating cash flow is not consistently increased every year. Capex spending is not higher than the operating cash flow. So Capex is well supported by earnings and positive free cash flow for every year. Both are good. Overall, from the financial section, high other income is not good. Others are okay. Profitability side, the operating profit margin of 5-year average is 18%. And net profit 5-year average is 14%. So both are more than 10%. So good operating profit and net profit margin. Return on equity 5-year average is 25% and return on capital employed 5-year average is 30%. Both are more than 25%. So company generating high ROE and ROCE. Then the leverage side, interest coverage is more than 20 times in the recent years. Company can easily cover the interest expenses even in bad economy when it is more than 10 times. So high interest coverage. Debt to equity is 0. And liquidity side, current ratio is 3 times and quick ratio is 2.7 times in last year. More than 1 is very good. And in the last 5 years, the company has more than 1 times, so good liquidity position. On the net profit, company retaining around 70% of profit for business expansion and growth. Dividend payout 5-year average was around 25 to 30%. So company reinvesting more earnings and given good and stable payout. Capex spending percentage of sales is less than 3% only. So it is a capital light business model, and free cash flow percentage of sales 5-year average is more than 12%. So it is cash generating business model. Alsman Z score is more than 7 times. So no credit risk in this company. From the ratio section, everything is good. Valuation is important for any investment. Let's find out the intrinsic value of the business by earnings based. The assumptions that I have considered, initial value considered as 77.1, which is past 3-year average EPS. Consider 15% growth for first 5 years and 12% growth for second 5 years in the conservative approach, 17% and 12% in moderate method, 20% and 12% in the aggressive method. Last 5 years earning growth rate is 18% and 7-year growth rate is 17%. So my growth assumption seems okay. And the discount rate is 12%. And the terminal value considered, the company will be sold at 15 times the earnings at the end of 10th year. From the assumptions, the intrinsic value of conservative approach is 2,372 rupees per share, and for moderate approach 2,553 per share, aggressive method 2,848 per share. I always prefer to take the conservative approach, and at the time of making this analysis the market value is 3,560 rupees. So it is overvalued by 1.5 times. As per the reverse DCF model, the growth rate should be 19.6% for the next 10 years to justify the current market price. In my opinion, the growth rate is very high. Our detailed fundamental analysis report with even more valuation metrics is available for you. Please check out in the description. This is promoter owned business. So promoter holding is 73.9%, FIA holding is 6.3%, DIA holding is 4.1%, and other investors holds 15.7%. So the promoter holding is high in this company. And the last 2 years trend of promoter holding shows they have reduced from 74.4% to 73.9%, and FIA is reduced from 9.5% to 6.3% in the last 4 quarters, and DAs are also reduced from 6.1% to 4.1% in the last 4 quarters. Motilal Oswal April month released a report for this company. They have forecasted the sales expected to grow at 19.6% for the current financial year and 18.4% for the next financial year. So good sales forecast. And net profit expected to grow at 23% for the current financial year and 18.8% for the next financial year. So good net profit forecast as well. That's all my analysis about L&T Technology Services. Please post your thoughts in the comment section and hit like if the analysis is helpful to you. We'll see you in another analysis. Thank you. Bye bye.